Well, good afternoon. Happy Friday, March 6th. Really, when we finished up last week, so 1 week ago today, we were at the tail end of February and experiencing the very best mortgage rates that we've seen post pandemic, really helping affordability for new home buyers, for move up buyers, also helping people who are looking to refinance from some of those higher rates that they might have had to close with going back a year ago, a year and a half ago, maybe even into 2024 and 2023. So, a very robust, active, early start to the spring buying market. Fast forward 1 week, and boy, we have such an interesting mix of things that have gone on. We know last weekend the United States began that military effort against Iran. Of course, the United States and Israel against Iran. Some call this a war, some call it a military action. However, you want to label it, it has caused a lot of turmoil in the stock market and a lot of turmoil in the bond market. Remember, mortgages are just long term bonds and very influenced by activity or turmoil in the bond market, particularly if what's happening globally is inflationary. And this military action, all the other consequences aside, which are certainly significant and important, if you focus strictly on what's happening economically, the price of oil is rising. In fact, from last week to now, we're talking about roughly 33 cents per gallon higher for a gallon of gasoline as compared to what it was. If that holds, if it just holds right here, we're going to see the consumer price index go from 2.4% up to 3%. That's a measure of inflation. The higher we go in inflation, the worse it is for bonds, right? Because that erodes a bond's value over time. The higher the inflation, the worse it is for bonds, which means the worse it is for mortgage rates. And we've seen mortgage rates across the board give back somewhere along the lines of about a quarter point in rate in 1 week. That is not welcome news. Let me show you what I'm talking about here. I'll flip the screen. We'll get to employment in a minute, but let's first look at mortgage-backed securities. So just as a refresher here, we want the trend line to go this way. We want to be rising in mortgage-backed securities because as the value of these securities goes up, interest rates come down. That's what we want. As the value of the securities decline, interest rates go up. This line right here, this beautiful line here at the top, that's kind of bluish green, that was last Friday, February the 27th. What a great time to be locking in an interest rate for a purchase or a refinance. This here is how we opened up on Monday. That's Tuesday, Wednesday, Thursday, and here we are on Friday. We actually opened up really poorly today, but we've bounced back to essentially a flat market here on Friday, and that's certainly welcome news. But some damage being done. This decline in mortgage-backed securities turns out to be the equivalent of roughly a quarter of a point in mortgage interest rates, right? And that's a lot to give back over the course of just 1 week. What saved us from things getting a lot worse? Well, it was actually the jobs report. Back to talking about labor. And frequently when we talk about the Fed's dual mandate, we talk about, hey, they want to promote maximum employment, but they want to keep inflation at their target level of 2%. And the employment part has been the really easy part for them so far. The labor market just hasn't broken. We still have unemployment sub 4.5% in this country. What's been the tougher obstacle here is getting inflation back to 2%. But suddenly today we get a non-farm payroll report that shows that we subtracted 92,000 jobs across the most recent 1 month in the United States. That is a significant contraction in labor and not what the market expected at all. We didn't expect to add a ton of jobs. I think the estimate was around 50,000 jobs would be created over the past 30 days, but we contracted and we actually lost 92,000 jobs. Healthcare, in fact, actually saw a contraction, and healthcare has really been the only darling of this jobs report going back for the past 6 months. Let me show you a little bit of a look back on what's happened with employment here. This data coming to you from Mike Simonson over at Compass Analytics. There's the $92,000 figure that we see, that 92,000 in jobs figure that we see that got reported today. Last month, a bit of an outlier with an increase, but you can see almost every other month involves some kind of contraction. Lost 140,000 back in October of 25, 70,000 back in August of 2025, and really a very complex employment picture here that's happening in the latter half of 2025, and then as we move into 2026. We don't see a lot of layoffs yet. Unemployment ticked up a tenth of a percentage point to 4.4%, But the jobless claims, which is really the data-driven metric around labor, that's how many people are applying for unemployment or continuing to apply for unemployment, that number hasn't really spiked yet. But we're not seeing a lot of hiring either. We're not seeing a lot of job creation. And this sort of low hiring rate that we're experiencing is almost at recessionary levels. We just haven't seen the layoffs, at least not yet. And that's equating to a bit of a frozen labor market. We see a bit of labor hoarding by employers in the United States. Not a lot of hiring, but not a lot of firing either. And whenever you have this kind of dynamic, you see a bit of a slowdown in activity. People are less apt to buy a new home when they're not 100% sure about their job. They're less apt to buy a new home if they're not assured of getting that promotion or that new job because the employer is just simply not hiring or not offering that promotion. So this is going to be an interesting dynamic to see play out, this job creation issue that we haven't seen post-pandemic until the past 12 months, and then also what's happening with inflation as the price of oil begins to spike. And are we going to see a return to 3%, 3.5%, even 4% inflation? I fear as long as this military conflict goes on in Iran, we are increasing the odds of that happening, and that's going to push mortgage rates a little bit higher. Now, the increase isn't substantial. It's just a quarter of a point. You're still seeing some really competitive levels of financing, but it's worth monitoring because we have so many different dynamic factors in play. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.